Right, well, thanks everybody for turning up and listening to our results for 2016. Good to see lots of familiar faces, but also one or two new ones. Standing here talking about excellent results is a very nice position to be in. Really need to thank all of the Keywords colleagues around the world for having produced yet another fantastic year of very strong growth, and obviously welcoming new colleagues as we go ahead with our acquisition strategy. Also, of course, we're fortunate in having very loyal clients that use us year after year after year for project after project after project. So that recurring element to our business is a very large strand of what we do. So I know we've got a slightly mixed audience here. The next couple of slides will set the background for those that are not quite as familiar with the story, and then we'll get into some of the details in terms of the numbers. What we do, we work in the video games sector. We don't make video games. We have no intention of making video games. What we do is provide essential services to those people that are making and publishing games. So we follow the life cycle of video games, which I should stress, and is pointed out by that circular arrow, is increasingly becoming a circular life cycle. No sooner has the game been developed than new content is added to it to keep the game alive. It's worth understanding that video games have moved dramatically in the last 3 years from being a retail product to something that is provided as a service. And with that, the name of the game has changed such that it's all about attracting users, retaining users, and monetizing those users. And the way in which you monetize users is through content. What's important for us as a business is content. So we start at the beginning of the life cycle with art creation services, everything from concept art through to art production, and everything you see in a video game is art. It's been created by people, using tools, of course, but it's been created by people, and we provide that. We're one of the leading outsourced providers for art. We move through into the audio space. Games are a very rich media. Within that, audio is a big part of it. It's the voice of the characters, it's the screams of the villagers, you name it. It brings the content to life. Localization is the process of translating video games so that they can be consumed by people that don't speak the original language. Original language typically being English, Japanese, Chinese, but also occasionally French and German. And we translate those games into 50-odd languages. When I'm using the word translation, this is not about making the content understandable, it's making the content enjoyable. So it's a highly creative, adaptive form of translation. And it's undertaken by very specialist games translators around the world working for us, and we coordinate and manage all of that on behalf of our clients. Functional testing, when the game is at its first playable stage, we get hold of the game on behalf of our clients and we effectively try to break it. We're looking to see whether the game performs as intended, trying to make sure that characters don't walk through walls, or that you have a crash and you lose all of your progress, for instance. Localization testing. The game has come back to us. It's the assets, the localized assets, the audio, the text, the translated material is back in the game, and we use native speakers operating from 5 secure facilities around the world to test those products, and that's the last stage that happens to that content before it's put into live. Once it's in live operation, we provide customer support, community management services. And then, of course, as I said before, the cycle continues. So if you're a console, if you imagine a console game, it's quite a big 50 gigabyte, 60 gigabyte initial game, perhaps delivered on a disc. But as soon as you start playing the game, you're offered downloadable content packs. And we work on that. And if you imagine a mobile game, content is just being delivered every single day to those games. And we support all of that. So that's what we do as a business. This is a little slide giving you a bit of an indication as to the titles that we work on. It's only a small spattering of it. You need to understand that we work on about 500 games in any one year, and probably we're working on about 150 games at any one time. So, you know, we do aggregate a lot of this content within Keywords. It's been an important part of our strategy since before IPO, but since coming to the market in July 2013. A big part of that has been to make ourselves a truly global player. The reason being that our clients, the likes of Electronic Arts, Activision, Tencent, Supercell, you name them, they operate on a global basis. We need to be able to support them in all of those territories and across all the services. So we've made very good progress in globalizing our business. Back at IPO days, we were 5 locations. We're now 27. Little pointers about our business model. We operate effectively as a time and materials business. So we charge for the work that we do in the month, and we get paid 30, 40 days after that. We're not exposed to the success or failure of any particular video game. So we're effectively, as an investment proposition, we're helping to iron out the kind of hits and misses that the games industry has been known for in the past. Also, like I said at the beginning, our relationships with the clients that are all supported with master services, multi-year master services agreements, make it very easy for our clients just to award us project after project after project. It's a very sticky business. If you worked on Assassin's Creed last year, the chances of you not working on Assassin's Creed again this year are fairly slight. You kind of have to have stuffed up typically. And so very high degree of recurring revenues. We're leveraging our geographic locations to provide 24/7 services, and we're able to further use those facilities to support multiple service lines in each facility. So, what does the year look like? Again, we've made further progress in making ourselves the go-to provider for video games services. The consolidation that we're doing through our acquisition strategy is designed to provide a really large, solid, financially secure platform that our clients can come in and use. They can turn us on, turn us off at will to support what is frankly a fairly lumpy business for them. And we help them iron that out and make it a lot more efficient. And we do that through scale and through expertise and to reach to particular talent pools around the world. Our numbers for this year, again, very, very pleasing performance. Revenues of about 97 million euros, get the currency right, and profits of 14.9 million euros. Very nice increases, 67% increase in revenue year on year, and 84%, 86% even increase in profit. So what's behind that? We've got 24% organic revenue growth. We report like-for-like measure because we're very acquisitive. So our like-for-like growth remains very strong. It's even, I think, a little bit up on the same growth last year. And then we layer in the acquisitions on top of that. So we've made 8 acquisitions during the year. It's important to understand that we're not just buying companies and leaving them as they are. We're actually getting on and integrating them. We're encouraging them to grow. We're investing in them. And we're leveraging the talent and the locations across the group. One indication of that is the fact that we have seen another increase in the number of clients that are using 3 or more services. So we've had a 25% increase in that metric. We now have 64 clients using 3 or more services, and that's out of a client base of about 400. So plenty more to go for. You say, well, 400 isn't a large number of clients, but it's most of the big guys in the industry. We're not best suited to providing services to the thousands of independent game developers out there, at least not at this stage in our development. Alongside that organic growth, we continue to invest in large premises. We continue to grow our Montreal facility year on year, really. We keep growing more space. We've increased our space fairly dramatically in Manila, in the Philippines, to support what's been a growth from about 20 people to 120 so far, with more to come. And we further expanded our operations in New Delhi. Acquisitions, you've got them listed there, all performing very nicely, all integrated or in the process of being integrated. Little bit of a note here on Synthesis, because as we said, I think in February and probably at the half year as well, that Synthesis had a particularly stellar year in 2016, really as a result of 2 or 3 very large games coming together, multiple languages, lots of audio recording, all at exactly the same time, which caused an incredible utilization peak at that time, which drove higher than normal profits. So we don't necessarily expect that to be repeated this year. But having said that, as we'll get into the detail later, all of our businesses, all of our service lines experienced good growth. So it's by no means all a question of the one business. Financial track record, again, though many of you in the audience know all these numbers probably better than me, but for those that are new to the story, we've continued to perform strongly year on year, and in fact, prior to 2013 as a privately held company, we also had a very nice growth record, albeit totally cash flow funded at the time. So what does that mean? So for us as a business, I mean, we just focus on doing what we do, right? We've got a strategy which we haven't deviated on since 2009. We continue to pursue exactly the same path. We are known for telling people about it and getting on and doing it. I think our execution is almost flawless. So we stand here today with the results of that action that we've been taking. We have 27 studios, up from 5, 6 service lines, up from 4 at the time of IPO, although to be honest, I think 4 was flattering us a little bit because, some of those service lines were very, very, very small. We're on 4 continents. We have used our listing in London on AIM to raise 24 million, which I think we've invested pretty wisely. All of that's resulted in a 290% increase in adjusted earnings per share, and our revenue growth since the last full year prior to IPO has been 62% on a compound annual growth basis. So we're very pleased. David.
I suppose this is some of the detail in terms of the key points touched on by Andrew earlier. I suppose it underpins the organic growth, the acquisitive growth, and the kind of consumer or customer behaviour that we're seeing. So obviously the revenue was up strongly year on year by 67% at 96.6. Gross margin continues to be consistent at 38, again slightly ahead of the same levels last year. Overheads, we continue to make progress as a percentage of revenues. I suppose our group stated target is to get to 20% of revenues on that, as we kind of leverage the underlying cost base as we grow the business and create the synergies as we bring in the acquired entities and grow this. Our adjusted profit, again, up strongly, 86% year on year, allowing for some of the numbers that we strip out to get back to our KWS defined profit. Our acquisitions up year on year from 4 to 8. And again, I suppose good cost control as we get into a more formulaic cookie cutter process in terms of how we execute these and roll them out, has helped to kind of control that cost despite the fact the number of acquisitions has gone up. Share option expenses up marginally. Amortization of intangibles, again with the acquisitions going up, rising. Foreign exchange, whilst up year on year, is unmoved from the half year. I think at the half year we would have explained that most of the movement was technical, as it were. One major move was about just north of €1 million due to the sterling proceeds from the placing that we had on deposit. So we had to take the FX hit on that. Otherwise, I would say broadly speaking, across most of our currencies, we have a natural hedge against our revenues and costs. So there's limited exposure. Our effective tax rate, again, the improvement year on year has been roughly about 1%. That's consistent with what you would have seen last year. So we continue to look at the group structures and organisation to make that more effective and try and bring that down year on year. And adjusted EPS, again, up strongly on the back of the results overall, up 61% to 20.59. Moving on to the balance sheet, again, strong balance sheet numbers. I suppose in terms of cash, marginally down in terms of gross cash year on year from 19 to 17 million. Net cash obviously down to 8.7 from 17.3. I suppose the big difference or factor in driving that is the increase in the acquisitions with 21.1 net cash consumed in that. We already touched on the cost of acquisitions at 1.3, and at this point we only have just north of 8 million of the Barclays facility drawn down, where the current facility is at 15. We would have highlighted in the release this morning that obviously that facility we've managed to increase up to 35 million, which gives us added firepower as we look out into the next year, and probably is a testament to the strength of the balance sheet and the numbers and the overall performance of the business in terms of that level. I suppose another big movement in terms of cash is an improvement in our MMTCs. I think you would have seen previously that we had a bit of an overhang from previous periods. We're effectively bang up to date in terms of what's due to come to us. So at the year end, we have a 2.9 million accrual. Only 100k of that relates to 2015, whereas last year you would have seen nearly 1.6 million relating to prior periods. So that's something that we've kind of bedded down. It's bang up to date, and you won't see the same kind of overhang there. Again, we continue to invest in the business. Obviously, there's the assets that we acquired through acquisition, and equally there's the investments that we make ourselves. Overall, just to highlight, I suppose of the 2.3 million capital expenditure, most of that is going into testing and computer equipment across our network of studios. In terms of locations that have benefited, again, most of that investment, Andrew touched on Montreal as a studio that continues to expand, Dublin and Manila, where we have our customer service operation, which you would have seen that we've scaled that quite significantly in the year. In terms of specific service lines, again, which have been targeted in terms of the investment, you will have seen Laksha and Mindwalk, which sit under the art service line, again being the principal recipients there, where we continue to invest back into the services. I suppose just touching on some of the other kind of movements in the balance sheet. Again, I suppose other receivables, that's a combination of WIP, MMTCs, prepayments. Again, the movement year on year to seeing it come down is part of our progress on MMTCs. And again, in part in terms of our billing and what sits in our WIP at year end. Other payables, again, broadly speaking, that's a combination of our accruals, freelancers, professional services. Again, we've more operations, things like rent, share option costs. Again, all trending in line with the overall business and the growth of the business in terms of the breadth and scale of operations that we have. Trade receivables, again, slightly ahead of the overall growth, but again, would have seen quite a strong close to the back end of the year. Our debtors' days are equivalent to the same as they were last year, I think just circa about 45 days. Really more a function of the year-end close as opposed to anything else. Cash flow, again, strong cash flow generated in the year, 15 million up from 3.4 last year. Again, MMTCs is slightly skewing the performance to the tune of about 1.6. Again, CapEx requirements for the business, we continue to see below 5% in terms of revenues, and we'd see that going forward being a comparable trend. Dividend, obviously for the year, 1.33, continuing the kind of 10% growth year on year that you've traditionally seen in terms of the numbers. And then obviously that gives a cash cost to the dividend of 830k for the year. So again, all of these going to demonstrate the strong performance year on year. some of the exceptionals that are kind of getting stripped out, and some of the key areas around tax, operational costs, where we continue to kind of target progress to drive the synergies across the business. Guidance. Again, similar to last year, organic and acquisitive growth looking to drive the business forward. Again, we talked about the operational costs, looking to continue that progress we've made over the last 2 or 3 years, get it down to that ultimate target of 20%. Effective tax rate, again, trend has been about 1% per annum, looking to continue to drive that through. Positive cash conversion, again, we'd look to get similar performance, albeit without the same impact of MMTC. Deferred considerations, again, just to help you with your kind of cash modelling for the year, stand at only about 250k for the year, and interest expenses, depending to what extent we pull down on the Barclays facility, will naturally increase.
So, looking at how each of our service lines performed during the year, and I think this is one of the most pleasing things for me, is that all service lines generated nice growth, as has been the case for most years. Not all of them obviously growing at quite the same rate, but overall very, very pleased. So art creation, which is one of our newer service lines, continued to power ahead, particularly in the second half of last year, and finished 34% up on a like-for-like basis. Luxury Digital in India, in particular, continued its fantastic growth performance. And in that service line, we now have a talent pool of 850 artists, making us one of the biggest providers of this external development service in the market. Audio services helped certainly by synthesis in particular, but that grew 20% on a like-for-like basis. And one of the things I want to point out about this service line is that we are increasingly being known not only as the go-to provider for multilingual audio, but increasingly now, because of some of our in-country studios in places like Brazil, Mexico, Italy, Spain, we're also go-to providers for those people that want to buy on a single language basis. We're opening shop in Tokyo at the moment. And again, we hope that that's going to drive more volume for Japanese audio recording. Localization, this service line continues to go like a train, very much organic growth, and in a large part actually powered by the growth in the mobile games business, where we are very fortunate to be working with many of the world's most successful mobile games. And as I said in the past, that just drives content on a daily basis. So it's a very demanding business to be in, but very rewarding from a financial performance perspective. Flavor for the size of that business. Last year we localized about 210 million words. War and Peace, which is a big book, it's about 500,000 words in War and Peace. So if my maths is correct, you need 400 War and Peace books. You have to imagine that as the output from that group. So it's pretty impressive. Thanks, Will. I'm glad there's somebody in the room that can do maths. Functional testing business, which is where we're effectively looking for bugs in the game. That grew nicely as well. Big improvement on the previous year, 23% like-for-like growth. Having acquired Enzyme towards the end of the year, that's adding further weight for functional testing. So if you imagine that slide I shared with you earlier where we had the pie that was broken down, I think functional testing represented about 9% of the business in actual terms last year. On a pro forma basis, including Enzyme, that is now up to about 13% of the pie. And there's plenty of scope to grow that business further. It's one of the areas of this business that is less outsourced than the others. Localization testing up 8% year on year, and customer support, although fairly small, grew 17%. And as I think we've said already, that business has made good use of the facilities we've got around the world and has seeded customer support teams into those. So, acquisitions, this remains an important part of the Keyword story. We congratulate ourselves, frankly, more on our organic performance than we do on our acquisition performance, but acquisitions is becoming increasingly embedded in kind of the DNA of Keywords. This is a very fragmented market. We are transacting more in terms of acquisitions on a regional basis. So the procedures, the execution of acquisitions has been devolved to regional teams, which is important because, doing 8 acquisitions a year, it would be very hard to try and do that all from a central point. A few takeouts. Player Research, which we acquired in October 2016, that helps us sort of sprinkle some of the smart stuff on top of the other services that we offer. We're actually just opening shop for Player Research in Montreal at the moment, and they continue to be very busy in their Brighton facility. Enzyme Testing Labs joined us at the end of the year. We are making good progress in integrating that. We're looking to combine what is now 3 facilities in Montreal into 2. And the Sonox business, which came to us at the very end of the year, is being integrated with our other two operations in Madrid. SPOV, which operates in the sort of cinematics, marketing trailers, in-game cutscenes, that is being co-located with Liquid Violet at some point this year, as we look to take on a single premise in London to house both them and to provide people like myself with an office to work from. Skipping over the rest of the acquisitions because we talked about them at the half year. Just want to see whether we've got anything that we need to particularly pull out of that. I think one thing to say is that Volta, in particular, which is the concept art business, that has continued to prove us right in terms of our thinking and our strategy, in that they get into the game development process right at the very start. And what we're able to do more and more is flow that work straight from the concept art stage through into art production. So we're able to mesh Mindwalk, Liquid Development, Luxure together with Volta and provide end-to-end services in art for our clients. A couple of case studies on cross-selling. So cross-selling is becoming increasingly important for us as a business. It's obviously always been our intention to do this, but as we get to the point where we have most of the big players as customers, very pleased to have made that progress. So the big opportunity for us becomes the ability for us to offer those clients more services from within our stable. Here are a few examples of that. So the first example is a multi-platform game developer focused mainly on console PC. We started this relationship in 2009, providing them with some localization testing. From that beginning in 2009, we rapidly grew that service over years with them to the point where about 60% of their volume for that service was coming to us year after year after year. And then in 2013, we finally got an opportunity to do some translation, localization work for them. I think they introduced a new language and didn't have a provider for it. Rolling forward another year, we started doing localization services for their Americas region. And then in 2015, we added the same services for their Asian region. So we were now covering that client across the globe. 2016 saw the addition of Synthesis to the mix, where they brought basically additional volume of the same services. And now in 2017, as we deepen that relationship further, we're talking to them about providing functional testing and customer support, which we hope to kick off fairly soon. So what that's meant for us is that since 2009, we've increased our revenue with that client by 600%. The next example is a leading mobile game developer. This is a business that we started working within as recently as 2013. They launched their first game with us in 11 languages, so we supported all the languages. They quickly progressed that game from 11 languages to 28 languages, and then again we followed them with all those languages. In 2015, they launched their second game, this time directly into 30 languages. And so in addition to continuing to support the first game with daily content, we've now got a second game in 30 languages. In 2016, we added art for the first time, so we introduced Volta to the client, who's now working with them. And in 2017, we've started to add customer support and localization testing for the client. So this is very much sort of organically built cross-selling with a very successful mobile game player. And that's led to a fourfold increase in that revenue from that client over only 3 years. The last one is a leading online games operator. We started working them in 2015, providing a range of audio and localization services. In 2016, we innovated with them and created a dedicated operation where we house both translators and testers together, working in a highly iterative fashion. It's a very effective way of working, and together with that client, we're scaling that business again in 2017, and we should at least increase by 30% the work we do for them. So that's one area where we create synergies through cross-selling. But there are some other operational areas where we do the same. So shared management systems. We have common operating platforms for each of our service lines, which support those service lines on a global basis. So we can monitor and measure those businesses wherever we are delivering the service. The one exception to that, I should say, is art, which we're still in the process of selecting a common operating system for that service line. And as we acquire companies, so they go onto these shared management systems. So we have the situation, for instance, where we're just moving Enzyme this month onto the same operating systems that are used in our functional testing and our localization testing businesses. Translation that they were doing has already been moved to Keyword standard platform. We consolidate our studios. So I mentioned that we're consolidating Sonox into our Kite team operation in Madrid. We're also doing that in Montreal, where Enzyme came with a studio in Madrid as well as one in Saint-Jérôme. We don't need the two operations in Montreal, so we will be consolidating those. We share talent. We're very pleased in that we're able to move our talent around the globe across the different businesses, and increasingly within service lines we're able to leverage, for instance, people that have been working on a game up to the launch period, whether that be functional testing or localization testing. We can run those guys through into the customer support phase of the operation, particularly important at the time of launch, because those guys know the game backwards better than anybody, so they can provide a lot of solutions to client problems on the first contact rather than having to escalate them to developers. And we're utilizing our geographies. So as we enter a new location, so we're able to not only expand that, we're able to offer different price points and so on to our client base, but we're also able to leverage them for multiple service lines. Common theme, how do we manage all this? I think you've seen this chart before. The point to make here is we continue to invest in the team. We've added an IT director during the year. We've also added a chief customer officer who came to us from Electronic Arts, where he managed the same sort of services that we provide, he managed those on an internal basis at Electronic Arts. And this year we will be appointing an HR director as well, which will help support the regional HR directors in the territories. Worth also mentioning, of course, that having a shared service for sales, where we now have, I think, 12 sales professionals, that helps to facilitate cross-selling as well, rather than having the sales teams embedded in each service line. So looking to the future a little bit, our strategy and opportunities. So, continued organic growth. What you should expect from us, you definitely expect us to continue to leverage those customer relationships, to be able to use those master services agreements to make it easy for clients to tap into all of our services. We also see increased opportunities for managed services. So we have a few clients where we provide the services that we are known for. We provide those in-house to our clients in their facilities under our management. Or indeed, we provide them on a dedicated basis within our own facility, but dedicated for the client and managed for the client. You also expect us to continue to extend our services, as we've done obviously with the likes of enzyme and player research that's taken us into the sort of user experience side of things. And also, as I mentioned earlier, opportunities for further expanding our single language audio options from Italian, Spanish, Brazilian, Portuguese, Arabic that we're known for. We're just entering the Japanese market now as well. Onto acquisition strategy. So we did 8 acquisitions last year. People ask us, how many acquisitions are we going to do this year? The answer is, I don't know, but we do have a very strong pipeline of acquisitions, and we hope to continue to do so for many years to come. So we're being very selective about those acquisitions. We put culture, fit as number 1 criteria. Beyond that, obviously, we're looking for companies that have the potential to grow with our support. But particular areas that we're looking for, each service line has their own strategy. Some of those service lines have a bigger acquisition component to their strategies than others. Localization, we continue to look for particular single language providers in particular territories. Functional testing, we're interested in expanding outside of Canada and the relatively small but growing operation that we have in India. Eastern Europe is an obvious area to look at for us. And for art production, we set foot in China for the first time with the acquisition of Mindwalk. We now have, I think, close to 280 people in Beijing. But China is the largest single market for art services, so you should expect us to continue to invest there. But Southeast Asia in general is fertile territory for art talent. So that's on our radar, as is Latin America. It's a smaller, less developed market, but interesting for the time zone similarities with North America in particular. New services, I think I've mentioned this before, but engineering is very much on our list of services to enter, probably through acquisition initially. And we maintain a watch on what's happening with game analytics in general. As games become a service, so analytics is becoming an important part of optimizing that service. And we would like to be able to provide that service to our clients. So geographic expansion, it's not something that's a major driver for us anymore. We feel we've got the global footprint we need. But Southeast Asia for art and Eastern European markets for art, functional testing and engineering are all obvious locations for us. So onto the market outlook itself. We've chosen a good business to be in. The video games industry continues to grow apace. Growing compound annual growth rate of about 7% per year. Should take us up to about 120 billion by the year 2019. And within that, content is continuing to explode. Virtual reality kicked off in 2016. We have worked on a large number of projects, virtual reality projects in 2016. Expect to do more this year. And hopefully we'll see those games becoming larger in 2016. A lot of them were more of the sort of virtual reality experience type rather than full games. Also coming up this year is augmented reality with Microsoft's HoloLens and Magic Leap's device as well. Don't have launch dates for those yet. Not entirely sure that they're coming out in 2017, but there is a lot of speculation around those. Also to note really, which I think in many ways is more impactful this year, is the launch of the Nintendo Switch device, which kicked off in January. Early indications are that it's got off to a good start. We certainly hope to see Nintendo back in the console market alongside PlayStation and Xbox. For us, that means another device to test games on. It also means that our clients have a particular platform to target games on, because it's different. It's not the same as an Xbox or a PlayStation. It offers a different experience to users. So hopefully we'll see some content specifically designed for that platform. Comment here as well about the rise of mid-core gaming in mobile. So mobile games, a lot of us still think of mobile games as being very casual in nature. We need to move on with that thinking. You know, now mobile games are very immersive, long-running, complex role-playing games. Mid-core being, you know, not as hardcore as some of the stuff you get on, use the word correctly here, not to mislead anybody, hardcore in terms of gaming terms. You know, their appeal to very experienced gamers, which is what you see on AAA console platforms typically. Whereas mobile has been casual, now we're getting more of a convergence there. We're also seeing 3D art come thick and fast into mobile, whereas mobile art has typically been two-dimensional. And again, that creates more work for us in our business. Current trading and outlook. So the first few months of the year have got off to a very good start. We're very pleased with where we are, very much in line with our expectation for the year. And we approach the rest of the year with a lot of confidence. The organic growth obviously remains very much a focus of ours as we capitalize on the synergies that we have got from the investments we've made in facilities and also the acquisitions that we've achieved so far. An important point here in terms of the acquisition strategy in particular is the fact that we have now, or we're in the process of increasing our debt facility to 35 million euros from 15 million euros. That doesn't really translate into a big increase in gearing, because it's really in many ways just keeping pace with the growth in the business. And with debt being the price that it is at the moment, it would seem a bit silly not to make use of it, frankly. Final slide to leave you with, which is, I'm not going to talk through it all, but the way I look at it, high growth market, lots of proliferation of content, of platforms, all drive business for us. The fact that our business is time and materials, essential services, means that we can iron out a lot of the ups and downs of the video games industry. We're not hit driven. And we continue to have this opportunity to consolidate the industry, make ourselves more meaningful for each and every one of our clients, and further strengthen those relationships. So that's it for me. I think at this point we should pause for questions.
Morning, is this working? Will Wallace. I was wanting to ask you a question on your gross margin and competition, impact of competition. Do you have any aspirations to expand gross margin from here? Are there mix effects there? Is there a pressure on the gross margins that you're getting? Do you think you can retain 38% gross margin at the same time as getting your costs down to 20%?
Yes, is the answer. I think we can. So within that gross margin, it's important to understand that price or price increase is not a major component of that at all. So prices have been largely steady for 2 or 3 years now. What we're not seeing necessarily is a lot of downward pressure on price. I think part of the reason for that is that we've got our price point to the right level. So where we're able to drive good margins, it's because we are particularly good at operating those businesses. We achieve high utilization rates of our staff, and we operate very flexibly and efficiently. So we're not having a lot of cost at times when we don't have the work to deploy those people onto. The second part of the question, which was about the operating costs, I believe, our target is to get those down to 20% of sales. Obviously, as we saw with that management chart, for instance, we are continuing to invest in management as we grow. So it would be very easy to bring that number down very quickly just by putting a stop to that sort of investment. But obviously, we perceive good growth going forward for a number of years out there. But logically, as we add to our top line, so we shouldn't need to add to that sort of central cost number in the same proportion.
A couple of questions about localization and audio, please. Do you fear at all, obviously localization has been very strong and it's always surprising that, do you feel as though, I mean, looking at those case studies, do you feel at all though the upselling of localization or indeed other services have run their course? You saw sort of a big increase in 2014, 2015 when you're adding, and then you were more adding services. Do you see localization and that upselling opportunity more broadly as a continuing opportunity, and do you see, and how far do you see that opportunity running its course? And then just secondly, was there any underlying weakness within audio? Because it was down, I think like for like on 2015 was 79%, it was 20%, but within which synthesis would have played a big part. And so underlying, are you seeing any weakness within audio? I mean, sorry that it's hard to pick flaws,
Yeah.
but that was just...
Yeah, no, both good thoughts. So what I think we're seeing in the localization side of things is the natural consequence of what we've been saying in terms of the increase in the amount of content that's out there and the number of languages that content is going into. Very well demonstrated, for instance, with that case study of the mobile game company that started with 11 languages, then proved to itself going to 28 and to 30 languages, and has now got a 30 languages as standard as it enters its third game at the moment. So I think that is really behind the growth of the localization business more than us upselling or cross-selling localization, although we're famous for it, so we are a go-to player for localization. And then the second question about the audio side of things. So the best way I think I can answer that is, so audio is still very heavily biased towards AAA games. Yes, audio is coming into mobile games, but it's not a big component yet. So if you look, for instance, at the results of Game, who announced recently, and I think they had a decrease basically year on year. 2016 they called out as being not a great year for retail. Retail usually means AAA content or console and PC related material. So and I think in fact at the half year we called out as well the fact that there is slightly less activity in that side of the market as a whole. So it may well be that you're seeing some of that in the underlying picture of audio. And part of that has been because of the impact of virtual reality. So a lot of our clients have put investment dollars and people into creating virtual reality experiences, presumably at the cost of something, and that something may well be AAA games. So that's not necessarily a picture that's going to be repeated going forward. And again, if you look at Game statement, they're saying that 2017 is going to be a much better year than 2016.
If we look at the 38% gross margin and the different kind of revenue streams that you've identified, what sits kind of above, below that 38% par? And
so I mean, I think the answer is the sort of the outliers would be art at the top end. I think the closer you get to the IP the higher the gross margin tends to be. And at the other end of the scale would be something like customer support, where arguably you further from the IP, and that tends to have a lower gross margin. But that's not the full picture. I mean, gross margin is not necessarily the best indication of net margin, and unfortunately we don't, well, fortunately or not, we just don't manage our businesses because we try to share as much as possible, so we don't measure them on a net margin basis for each service line. But if I was to think about them, something like the art business, higher gross margin, but its management cost, its operating cost is a bit higher than some of the other service lines as well, partly because the people in that sector cost more than they do in some of the other service lines. Whereas something like, and it also has a sort of on-off nature to art, right? It's not a continuous stream, like some of our localization is continuous, or indeed customer support being a continuous service as well. So customer support, you might say, logically would command a lower gross margin because it is a much more steady, predictable business.
If we then think about the cross-selling and what kind of implications that is going to have on that gross margin mix. And then one final question on, you said not seeing much evidence of price pressure. Are you seeing much kind of cost pressure on the cost of sales?
Okay, so the impact of cross-selling. I think the mix gets you to something like 38% gross margin, so I don't think that the effect of cross-selling will have any material impact on the gross margin. Obviously, if we grow our art business substantially, then obviously that, as a percentage of the whole, that's going to skew things a bit in that direction. Likewise for customer support, if we suddenly, quadrupled our customer support business, it might pull things in the other direction. But I don't think that cross-selling per se has any particular impact on the gross margin. On the cost side of the business, we have wage inflation. We, in particular, we expand our premises as our volumes increase. So those costs go up a little bit, but not necessarily as a percentage of the total. So where we have been very good is that we're operationally very efficient, and we're quite good at continuing to improve things. So I think we've managed to absorb the small amount of cost pressure that we do have in our businesses. We've absorbed that in the margin. And certainly, when I see other companies, because obviously we're out there doing acquisitions, I can honestly say that we're probably one of the most efficient operators out there. And we intend to continue that way.
I was just wondering, could you give us more detail in terms of what engineering and analytics, where they fit into that cycle of services, and just what those services would entail to the game developers?
Yeah. So engineering really is about coding. So games are a combination of the content, the creative element, the story, and then the technology, the AI that sits behind them that drives the player experience. So that programming accounts for about 40% of the cost of a game, with art accounting about 50%. As games become bigger, as they become more complex, so we see more of that programming effort being outsourced. And so for us, when we think about engineering, it's providing that as a service to our clients, preferably on a time and materials basis. And it's either working alongside our clients on a game where we are doing a particular element of the development under direction from the client, or it's, for instance, where a client has developed a game with a focus on a particular platform and they want that same game ported to another platform. So those porting services, it's not about impacting the creativity or the gameplay of the game so much. It's more about heavy lifting and taking something that's already been created and moving it to another platform. So those are the sort of services that we see. We're constantly asked whether we can provide those services by our clients, particularly those clients that buy art from us. As you can imagine, very closely linked, art and engineering. Very much at the stage where you're in production, building a game. It's kind of a all hands to the pump exercise, creating one of these games. So that's where that sits. Analytics sits further down the life cycle. So as games enter live, the games have a lot of hooks in them. They generate a lot of telemetry about player behavior and so on. And so the ability to use very smart models and tools to interpret that data and to be able to refine the gameplay or the interactions or the messages that you provide to players in real time becomes very, very important, because you can make very large gains by very small incremental changes. And you do that through the use of analytics, because otherwise the amount of data is just too overwhelming to cope with.
Yeah, I've got another question on gross margins again, just to go back. You referred just earlier to the possibility of maintaining gross margins where they are. Obviously, last year you had exceptional performance and synthesis with very strong utilization. When you're talking about maintaining gross margins, is that should we be thinking about after we normalise for that effect, or actually do you think that it will be possible to move forward at actually the 2016 level?
That's a very good point. Thank you for pointing that out. I'm going to ask David, but I think probably the answer is after normalising for synthesis.
After normalising, I mean, I think it's reasonable to expect a similar level, all things being normal, for 17. I mean, if you strip out synthesis, it's probably, for 16, it's probably slightly down, but not hugely.
Could you talk a little bit about what happens at an operational level when you acquire some of these studios? So, for instance, do the KPIs change, and what do they have to do to become a Keyword Studios company? And secondly, is there any pushback on that?
Yeah. So I think the first thing to say is that we're fortunate. We are the leading consolidator in this market. So we are the guys that are doing the buying. And so we have quite a bit of choice, effectively. And as I said, number one criteria for us is cultural fit. So we would tend to buy those companies that we think will fit best with us, which is how it's possible to absorb them in and into the sort of Keywords culture, and to seamlessly move projects around, knowing that they're going to be treated in a very similar way, and our clients aren't going to see any major disruption as well. Operationally, what happens is, as I think I mentioned, we're starting to use our regional folks to carry out a lot of these acquisitions. So, okay, it might come through me for initial pricing and for the heads of terms, but then it's the regional guys that get on and actually execute the acquisition, and they build up the integration plan as part of that, and then they move straight into the ownership and the execution of the integration plan. So ownership is where it should be in terms of all of those actions. The companies that join Keywords, they do it for a number of different reasons, obviously, but one of the reasons is it can sometimes feel a little bit lonely and risky out there as a small standalone business. So suddenly finding themselves part of a bigger family that's more supportive, that's encouraging them to grow, that's providing the dollars, the investment dollars to do that, is really quite uplifting for them. And we see time and time again that these companies perform better under Keywords umbrella than they were performing under their own steam. And I think the reason for that is simply that they're able to be braver and to go out and get that growth without having to worry about a client pulling a project from them from one year to the next.
You talked about 500 games a year.
Yeah.
how many would you like to work on? Not the minnows, but what's out there that's attractive?
Yeah, I was hoping no one was going to ask me how many games we would like to work on, because I don't really know. The truth is that we work on so many of them. It's not so much about whether we would like to work on how many more we'd like to work on. It's more about how many more services we'd like to provide to each game that we work on. There are, however, a few game companies that we don't yet work with very much that we would like to work with a lot more. So, amongst those I would list leading companies like NetEase and Gung Ho come to us. These are very large players in China or Korea. In fact, we've just started working with one of those on that list, but it's been a while coming. So, yeah, I think for us it's more about how many more languages can we provide per game, how many, how much more art, or what percentage more art can we provide per game and so on, than it is about just more games.
Do sort of 500 games, so let's say 100 million turnover, 200 grand a game. How would you like to see that, and what do you think's achievable?
Honestly, a lot of those big games, they can support a few $1 million worth of our services per game. Not all games are going to be of that size, obviously, but it's an interesting metric to keep tabs on, I think. And I think over the time we'll find that 200,000 per game grows quite substantially. I don't have a target as to what it should look like, but certainly for some games we're already doing north of $1.5 million per game. But there shouldn't be any reason why for those big games we can't do $4 or $5 million on a single game.
Could you talk a little bit about management of utilization in something like art creation, where I guess hiring talent and keeping that and kind of managing the utilization is much more different to something like localization, I assume?
Yes, I can. So to give you a flavour for the overall business, we have a very flexible resourcing model as a business as a whole. Some metrics on that. I guess our permanent staff base is something like about 1,000 people worldwide. And we will peak at last year we peaked at about 2,600 or so. About 2,600 people. So that the difference between the permanent base and the rest is flexible contract staff of one sort or another. But these are people that are on the payroll. Within the art business, art is actually the least flexible in terms of those models, particularly when it comes to the Asian operations in India and in China. They don't have the same flexible working behavior that we see in the Western markets. So permanent employees for the most part, you're talking about kind of 400 odd artists in India and about 200 artists in China. Those guys are permanent employees, and obviously the challenge there is matching the work with the talent pool that you've got. And at the same time we're growing as well, so you're having to pull talent on, train it ahead of the curve. You've then got the capacity, you can take on more work and so on. So the utilization in that business is lower, frankly, than it is in our other business units. But that's an opportunity for us. But it's also in part a function of just the way that business works in those territories. So, yeah, does that answer the question?
The other question I had was in terms of opportunity. So I assume many of the larger publishers provide all these services as an in-house service. So there's in-house function. And the opportunity for you, is that incremental to that, i.e. additional business beyond that, or are they actually looking, just as the IT services industry has grown over the last 30 odd years, they are looking to basically outsource that whole of that function over time? If that's the case, do you have an opportunity to either buy those captive centers out of those publishers?
Favorite question. Yeah, you've spotted something exactly. So look at the games industry, compare it to the sort of enterprise IT market. Very different stage of maturity. Video games, fairly young industry, 25 years old or something. started and grew very much in a vertically integrated in-house model. Slight trends towards outsourcing for some services, I think probably starting with things like localization, where they just would never think about, getting the audio studios for French, Italian, Spanish, German and so on in-house. It makes sense to do that remotely. But, art has been growing quite a lot. Art in the last 3 years has grown tremendously in terms of a move towards outsourcing. It's now accounting for about 50% of all of the artwork is now outsourced. And I think that's trending very fast to 80%. If you look at something like functional testing, still mainly insourced as a operation, it's an in-house service. It makes a huge amount of sense, to my eyes, to move to a more mature model where they actually flip out that internal service to an external provider. I don't see any reason why our clients would want the distraction of managing a highly operationally intensive service like that, alongside trying to make the right bets in terms of their IP. And so, yes, we very much hope to be a beneficiary of that. So we've experienced it on relatively small scale a couple of times. So one was where Electronic Arts invited us to take over essentially their Southeast Asian operations out of Singapore, which we did very successfully. And we've basically taken what was a captive service, made it multi-client, we've grown it, and we continue to offer those services back to Electronic Arts, but on a turn it on, turn it off kind of basis. We've done the same thing with a French developer publisher called Ankama, where we took over their operation in Manila, which was a live operations support team. And again, we've expanded that to a multi-client operation, with the benefit of a 4-year contract with Ankama for the ongoing service as well. So small moves in that direction, but personally I believe that this market will see some fairly major re-engineering of their businesses over time, because their world is becoming more and more complex, and I can't see how they can continue to focus on all things at all times.
Just last question, in terms of margins in some of the activities you are doing, is there opportunity to introduce more levels of automation, like for example functional testing? Is it as automated in your world as it is in the enterprise world?
No, it's not. Number of reasons for it. Games are highly complex. Each game is different. The actual structure of the game is different, and they're very fast moving. So by the time you've invested in the development stage to put in place all of the hooks and the harnesses and the automated testing approach around the game, without knowing whether the game's going to be successful or anything, not many people do it that way. There are small increments in automation. We develop some tools and techniques around that, as do our clients. So it's a regular sort of ongoing matter, but it's not a huge. It's not having a huge impact yet on that business, and partly because of the nature of the product. Frankly, it is just that much different from something that's more rigid in its makeup, like a enterprise software suite or something. All done. Thanks for coming, and